once there's a default at the big boy level, then the game is over. Everyone will know that everything that people have been whining about for the last 20 years about the manipulation and the foul play going on in the precious metals market, at once everyone will know it was true.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Special of the Week for October 11th through October 18th, 2022. Kilo silver bars from JBR Recovery. These 3 9s fine bars are cast with an individual serial number and are LBMA Good Delivery accredited. They also have the unique distinction of being refined to a high purity from recycled sources. Best of all, they're available at only $3.50 over spot while supplies last. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Dave Kranzler from Investment Research Dynamics. Dave, thank you so much for joining us today.
Thanks for having me on again, Elijah. It's good to see you.
It's great to see you too. I wanted to discuss your recent article. You mentioned how technically precious metals are looking very bullish right now, possibly poised for a rally. Now, a lot of people out there are talking about how, gold has broken through a key support level, and it could be going lower from here. But why do you think we're headed higher?
Sure. I mean, technicals are technicals. I tend to look at the markets more from a fundamental standpoint. And in my opinion, the fundamentals are lined up fairly similar to the way they were lined up in late 2007 and in 2008. Only this time, I think the fundamentals are much stronger than they were back then. The same fundamentals that would support a big move in the precious metal sector, much more powerful this time around. Now, yeah, absolutely, the price of gold can go much lower from here, but on a technical basis. But again, I say this over and over, and the precious metal, the gold and silver market is a bifurcated market. You have a paper derivatives market on one side, and you have an actual physical market where physical deliveries off of the exchanges and out of the custodial vaults into the end users occurs. That's where that's where the real gold market is. And right now, the paper derivatives market, primarily the COMEX, is what's driving the price, and it's what's driving the price lower. And you can see that in the weekly commitment of trader reports, where the hedge funds have been they're now net short paper silver. In other words, their gross shorts exceed their gross longs, and it's been that way for a couple months now. And the COMEX market making banks are net long paper silver, and they've been aggressively covered. Now, the banks have been aggressively covering their gross short positions over the last several weeks. Now, last week it kind of reversed a little bit. But I wouldn't be surprised if, when the commitment of traders report comes out today, that it shows that the hedge funds were shorting paper, silver, and gold again, and the banks were using that shorting to cover their shorts. So, and it might not show up until next Friday, because the cutoff date for the commitment of traders report is Tuesday, even though it's something that they could publish every day. The CME could, and it wouldn't be much more expensive than it is to publish it weekly with a 3-day delay. But, their intent is to try and keep the market as opaque as possible. If you look at the physical side of the market, Ronan Manley's been doing fantastic work detailing how silver is it's flying out of the London vaults. There's just been an extraordinary decline in the level of physical silver out of the London vaults. And a lot of that silver is actually going to India. India's and the import numbers from India show this. India's been a rabid importer of silver this year. It's also going, to mints. Retail are big buyers of physical gold and silver right now, minted bullion coins and small size bars. And there's also been a decline of the gold and silver vault inventories on the COMEX. Not quite as dramatic as we're seeing on the LBMA, but it's there. I mean, the silver vault warehouse stock is down, and I haven't looked at the numbers in the last couple of days, but it's probably down about 14 or 15 million ounces from the middle of the summer, from July. And the on a percentage basis, the gold inventory is down even more. So, in my opinion, at some point, this is what we're seeing here is Gresham's law in action, right? Bad money chases good money out of the system. So essentially, all this paper fiat currency that's been printed is your bad money, and smart actors, smart economic actors, are taking their fiat paper currency and as much of it as they can afford to, and converting it into physical gold and silver, and taking it out of custodial safekeeping. Because if you leave it in custodial vaults, technically you don't really own it. So that's just one factor that I think is going to drive the price of gold and silver. At some point, the physical market will provide an upward thrust that prevents the paper market manipulators from shorting a lot more gold and silver derivatives. And it's not just on the COMEX, it's on the LBMA. And then there's also OTC, lightly regulated OTC derivatives, which, I mean, that's probably the most opaque part of the paper gold and silver market. So, and then I don't know that I need to review the fundamentals on the economic and monetary fundamentals on why the price of gold and silver are going to go higher. But I think it's going to happen very similar to the way it happened starting in late October 2008, where all of a sudden, as the stock market was heading south and the credit market was imploding globally, all of a sudden gold and silver took off. And I mean, the Amex Gold Bug Index doubled in the last 2 months of the year in 2008, and the GDX ETF more than doubled in the last 2 months of the year. I do think we'll see something like that happen eventually. Who knows what the timing is on that. One other point about that, because obviously the massive run higher in the dollar has been getting a lot of attention, and that's part of what has been stimulating hedge funds to short gold and silver futures. What they're doing is they're chasing the dollar higher in the futures market, and they're offsetting that by shorting gold and silver, right? Because the dollar goes up, gold's supposed to go down, right? Well, it's not always true, but at any rate, the same thing happened in 2008. If you look at a chart of the U.S. dollar back then during the summer, the U.S. dollar went straight up right before everything imploded that fall. And, again, I think the dollar's sending us the same type of signal right now as it was back then. And again, I think it's going to be more extreme this time.
From your experience, what you're seeing of the metals being taken off the exchanges, how is there precedent for this in the past? I mean, is this more dramatic than we've ever seen before?
I haven't gone back to look at the charts, but yeah, we've seen the same thing when there's periods of turmoil. I mean, at some point, there's enough entities globally that are demanding physical gold and silver for delivery. And I mean, it's the vaults in London and New York that have to supply it over and above what gets produced by gold and silver miners every month, right? Or every week. So, I mean, I can't prove this, but enough people have alluded to it. But big banks that are the major, they're one of the biggest market makers in London and New York for derivative gold and silver. They have contracts with Barrick where they just, they buy gold as it's produced from Barrick. It gets drop shipped to Switzerland, refined, and it goes into Asia, in kilobar form, which is what the Asians prefer, as do the Indians. So when at the margin, when there's not enough gold and silver to supply what's being produced on a weekly basis by the major gold producers. And that's when you start to see the vault levels go down. And that's what we're seeing right now. And I will say this, part of the reason that the premiums, especially for silver eagles and minted silver products, is so high is because there's massive retail demand for those products, but the mints are constricted in the supply of silver blanks that are sent to the mints so that they can produce enough to meet the supply. If they could produce enough, to meet the demand, if they could produce enough on a daily basis to meet the demand, the premiums wouldn't be this high. And it's not the coin dealer's fault that it's this high. They're not gouging the end user. It happens at the wholesale level. So what I believe, and again, I can't prove it, but we've seen this same pattern enough times over the last 20 years. When there is a growing shortage of physical gold and silver that needs to be delivered by the banks into the big boys, meaning, China, India, etc. Turkey's been a big buyer of gold this year. Those are deliveries that these banks can't default on. And so if they need extra supply of gold and silver that gets produced and refined, they're going to cut off the supply to the mints. And I think that's what we've been seeing since probably early this past summer, because that's when the premiums really started to shoot up.
No, looking at, definitely what we're seeing on the physical level here at Miles Franklin, we're seeing huge demand for physical metal, and I know wholesalers are running out of product. Your perspective on that, that it seems like there's a demand for physical metal on the large level, off the exchanges where people are taking, large institutions, it seems like, are probably taking physical delivery, but then also on the retail level, there's huge demand as well where, wholesalers are being wiped out.
Right. Well, and that addresses my point that physical gold and silver, that as it's produced, gets redirected away from the mints because they need to deliver it. If Andy gets a phone call for a big order of silver eagles and he says, I just can't deliver it. If you want, I can order it for you, but I don't know how long it's going to take to come in. He can't sell these guys silver that he doesn't have. And that's the same thing with the big banks. If Indian importers are asking for a lot of silver, the banks have to supply it, especially if they're short LBMA forwards or COMEX futures. And so the bank, once there's a default at the big boy level, then the game is over. Everyone will know that everything that people have been whining about for the last 20 years about the manipulation and the foul play going on in the precious metals market, at once everyone will know it was true. So these banks will kick and scream and claw to avoid delivery defaults. And that's why the easiest source to cut supply off so that you have supply that prevents defaults into the big boys is to constrict the supply that goes to the mints at the retail level. So what if the little guy, has to wait for his silver or has to pay a high premium? The Indians aren't paying a premium like that. The Chinese aren't paying premiums like that, but it's happening at the Western mints. At the Western mints that are supplied by these wholesalers who can't get supply.
And as you mentioned, we are seeing delivery delays as well. Pretty much all sovereign coins are at least 2 to 3 weeks out right now, if not 2 months.
Let's put it this way. I bet if the mints were allocated as much silver as they needed to produce as many minted products to meet the demand that they have, the premiums would shrink quickly, and the amount of supply that would be distributed through the mints would double overnight. And your order book would go to the moon because the overall price would fall, and that would increase the demand for silver.
No, that's and that brings into the point that, we are seeing a lot of inefficiencies from the mints lately in the inability to produce the product right now.
Right, because they don't have enough blanks to produce them.
Right. And so your point then is that it's because of an actual silver shortage. That's why they don't have there's just not enough silver out there. That's why they don't have the blanks. Is that your point?
There's not enough silver to satisfy the demand that's coming from the mints and make deliveries to the big boys around the world that the banks are making deliveries in. Well, I'm talking large size deliveries, right? Millions of dollars, tens of millions of dollars, hundreds of millions of dollars.
Can you remind our viewers then what is the end game of this if this kind of demand continues?
I mean, at some point you're going to have a delivery default, and there may have already been delivery defaults, but it doesn't. We had delivery defaults in March 2020, and they papered over it with the goofy, new contract that shares the allocation of gold between the COMEX and the LBMA. It's called the ACE contract. I don't know if you remember that, but they were on the precipice of defaults that would have been devastating to the banks that are short derivatives. So, I mean, at some point, again, I believe that over time, not necessarily in the time frame that we would like it to have happen, but over time, at some point, the market will correct this, and the market, and what will happen is there's going to be a notice of a default to a big boy that is made public, and then it's game over, and then you're going to see the price of gold and silver shoot up very quickly in a very short period of time. You're going to hear about you're going to hear about banks blowing up on their derivative shorts. And it's going to be chaos for a while in the precious metals markets. That's when you're going to have a real bona fide gold and silver rush. And I think we're seeing a low grade one now. I mean, you've read the reports about UK coin dealers being cleaned out of gold as a result of what happened with the pension crisis over there. Well, and you guys are obviously short product. You don't have enough to sell into the demand that you have. And, again, to me, that's an indication of Gresham's law. And it's a low grade gold and silver rush going on.
And that's what I'm hearing is this could just be the beginning of what we're going to see in the future. And definitely, as you mentioned with the UK, what happens to the country's economy and the global economy can impact the demand. And we are seeing, you also wrote an article about this, that we're seeing a huge amount of risk out there in consumer debt, and how so many people out there, we talk about like the national debt being large. We talk about banks' balance sheets being an issue, but a lot of people don't talk about, wait a second, the American people are also very much insolvent as well. Your perspective on that and the risk associated with that.
I mean, you pretty much summed it up right there. The average household is living hand to mouth. Real income levels have been ravaged by inflation. And I mean, I've read articles over the last couple months where a lot of households are making the choice between making their mortgage payment or making their car payment, and car loan delinquencies and defaults are starting to rise, and it's going to rise more quickly. You're seeing evidence of household extreme tight financial conditions with the fact that the major retailers like Walmart and Target and Best Buy, their inventories are going through the roof because they can't move the inventory that they've ordered over the last year. A lot of it isn't selling, especially the discretionary items. And so, a large portion of American households have been forced to just kind of live paycheck to paycheck to make their house payments, to put gas in their car, and they may be already be in default on their car loan, and to put food on the table for their family. So, and you're seeing outstanding credit card levels are starting to approach, or actually, I think we're at record levels now, and it's been increasing. That the amount of increase in credit card debt over the last several months has been huge because people are using their credit cards now to make ends meet every month. Lending Club does a survey, and the latest survey showed that 30% of consumers who make over $200,000 a year are living hand to mouth. So it's not just confined to the average household income demographic. It's starting to reach into the higher levels. So And obviously, we're already in a recession, regardless of what Biden says, and it's gonna get to, it's gonna get a lot worse. You're starting to see big layoff announcements on a weekly basis, and all of these people who are living paycheck to paycheck and then lose their job, and they have large levels of debt, mortgage, auto, credit card. They're not going to be making those debt payments, and we saw this is what happened in 2007 and 2008, but now all these problems are much larger in scale than they were back then. The debt levels outstanding are much larger in scale. The extent to which a lot of people overpaid for their house over the last 2 years is much worse than the overpayment for houses was back then. So I think we're I mean, I don't want to sound like Nostradamus, but I think we're in for tough times going forward. Now, one more point here. If you want to watch something that, as much as anything, can tell you what's going on in the credit markets, you can monitor something called the MOVE Index. And the MOVE Index is basically the VIX for the credit, for the bond market. And the MOVE Index, I take this back to 2003 because that's all TradingView does for their free software. But the MOVE Index is as high as it was back in 2009. But the difference between now and then is that the MOVE Index was coming down in 2009 because all the money that the Fed and the other central banks were printing started to calm down and paper over the problems that had developed in the credit markets. But if you go back further than that, when the MOVE Index was moving higher, we're back to where it was in August, early September, late August of 2008. Now, you probably don't have to think back too hard to remember what was going on back then with the markets and the economy, et cetera. So that's where we are now. We're going to see the MOVE Index is going to start moving even higher. And I think that's when the real roller coaster ride starts in the markets.
And we're seeing this all amid, again, pretty much record inflation. We still have the CPI, if you want to trust that, at high levels, over 8%, still higher than expected this last month. So it seems like definitely a rough road ahead here.
Well, I think so. And I also don't think that hiking interest rates is going to fix the inflation problem. Alistair McLeod, I don't know if you follow his work. If you don't, you should. He's a brilliant analyst, and he wrote an article. It was actually one of his easier ones to read. Sometimes they can be kind of long and dense, and they take a while. At least for me, anyway. So I'm kind of dumb, but it takes me a while to get through most of them. But this one is called "Imploding Credit and the Consequences," and he outlines in there beautifully why just hiking interest rates is not going to fix the inflation problem. And I've been saying the same thing all along. Inflation is a monetary phenomenon, and it was the price inflation we're experiencing now is a result of all the money that's been printed cumulatively since 2008. Now, obviously, the pedants in your audience are going to say, "Oh, the central banks don't print money; they create bank reserves." That's right, but guess what? That's the intermediary step towards creating credit, which is essentially the same thing as money. Credit is money until the credit has to be repaid. Well, the amount of credit that's gone up in our system since 2008, it pretty much increases continuously. So that credit never gets repaid. So it's basically the same thing as printing money, right? Credit spends the same way as a printed dollar. You take a credit card out of your pocket and you buy something. That's the same thing as if you take dollar bills out of your pocket and buy something. The difference is you have to pay the credit back. So this article, it's not one of his longer ones, and I would recommend that if anyone in your audience who hasn't read it, take some time this weekend and read it.
Yeah, no, Alistair's work is definitely very brilliant. We have him on often on the channel, and our viewers can't get enough of his work there. So, but David, we really appreciate you coming on again today. Our viewers very much look forward to us having you back on. Before we let you go, where can our viewers find you, and any last thoughts you had?
Yeah, first I'd like to say thanks for having me on again. Your interviews are always enjoyable. You ask great questions, have great topics. My website is investmentresearchdynamics.com, and I don't post blogs as often as I used to, but I post free material there. And then there's also links to my mining stock journal and my short seller journal newsletters, and you can click on those links to find out what's involved. And I just added Stripe as a payment option on Mondays, so you don't have to use PayPal if you want to check out my subscriptions.
Fantastic. David, once again, thank you so much for sharing your insights today, and God bless.
Thanks, Elijah. Same to you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.